Passive income with Bitcoin. For most Bitcoin holders, the default strategy has always been to buy, hold, and wait. Often referred to as hodling, this approach has proven highly effective for early adopters, especially during Bitcoin's meteoric rises over the past decade. However, simply holding BTC doesn't generate yield, it only produces returns when the price appreciates. In a world where traditional investments like bonds, dividend stocks, or even savings accounts offer some form of recurring income, it's no surprise that Bitcoin investors have begun asking, how can I earn passive income with BTC? Before we begin, an important message: cryptoassets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. One of the earliest solutions came from centralized lending platforms like BlockFi, Celsius, and Nexo. These companies offered users interest on their BTC holdings in exchange for lending those assets to institutional borrowers. In some cases, rates ranged from 3% to 6% APY, depending on market demand and how much BTC was deposited. While attractive, these platforms came with significant custodial risk, meaning users had to trust the platform to safeguard their assets. Unfortunately, several of these services failed during crypto downturns, leading to billions in losses and a sharp reminder of the importance of counterparty risk. In response, the industry began evolving toward non-custodial options, particularly DeFi-based solutions and smart contract-powered protocols. While Bitcoin itself doesn't support smart contracts natively, projects like Wrapped Bitcoin, WBTC, on Ethereum allowed BTC holders to access DeFi opportunities in the broader ecosystem. WBTC is a tokenized version of Bitcoin that can be used in Ethereum's decentralized applications, DApps. By wrapping BTC, users could provide liquidity, earn interest, or even participate in yield farming, all while theoretically maintaining exposure to Bitcoin's price movements. Wrapped Bitcoin quickly became one of the most popular bridges between the Bitcoin and Ethereum ecosystems. Each WBTC token is backed one-to-one by Bitcoin, held in reserve by a centralized custodian. This system allows users to bring their Bitcoin into DeFi without selling it. Once converted, WBTC can be deposited into lending platforms like Aave or Compound, used in liquidity pools on Uniswap or Balancer, or deployed in yield-optimizing protocols such as Yearn Finance. Although the underlying BTC remains off-chain, users gain access to the full range of passive income tools available on Ethereum, albeit with some trust assumptions due to the centralization of custodianship. Another innovative route for Bitcoin-based income emerged through Layer 2 solutions and sidechains designed to bring smart contract functionality directly to Bitcoin. The most well-known among these is Stacks, STX, a blockchain that settles on Bitcoin and enables DeFi, NFTs, and apps to use BTC as the underlying asset. Through the Stacks ecosystem, users can earn Bitcoin rewards by participating in stacking, a process that is similar to staking but specifically designed for the unique structure of Stacks and Bitcoin. Stacking lets you lock STX tokens temporarily in exchange for BTC payouts from transaction fees and protocol emissions. RSK, Rootstock, offers another alternative, operating as a Bitcoin sidechain with full smart contract compatibility. It allows developers to build Ethereum-like DApps that use BTC as the native currency, while offering faster and cheaper transactions than Bitcoin's main chain. On RSK, users can lend BTC, provide liquidity, and participate in DeFi-like systems, all while anchoring security to the Bitcoin network through merge mining. This creates new yield opportunities without leaving the Bitcoin ecosystem entirely. While tokenized BTC and Bitcoin native sidechains offer exciting possibilities, they come with trade-offs in security, decentralization, and complexity. Wrapped BTC introduces counterparty and custodial risks, while Layer 2 platforms like Stacks and RSK require technical understanding and often expose users to different forms of smart contract vulnerabilities. Still, for those willing to explore these options, the potential yields, often paid in BTC or equivalent assets, can be compelling compared to simply holding BTC in cold storage. For those preferring a more conservative route, custodial platforms still have a place, provided they meet strict standards of transparency, regulation, and security. Modern platforms such as Ledn and Bitstamp offer interest-bearing BTC accounts where users can earn up to 1 to 3% APY depending on market conditions and duration of deposit. These companies emphasize regulatory compliance, audits, and transparency, attempting to restore trust after the collapse of previous custodians. However, the golden rule remains: not your keys, not your coins. Users must weigh yield versus security when using these platforms. Another emerging area of passive income with Bitcoin comes from the Lightning Network, Bitcoin's Layer 2 solution built for fast and inexpensive payments. Though the Lightning Network wasn't designed as an income tool, advanced users can earn small amounts of BTC by running Lightning nodes and routing transactions. This process involves committing BTC to payment channels and keeping a node online, which contributes to network liquidity and connectivity. In return, operators can collect routing fees. While profits are minimal and the technical requirements high, Lightning provides a true on-chain method of BTC income without tokenization or custodians. Operating a Lightning node is a niche pursuit, often more appealing to tech-savvy users or Bitcoin enthusiasts committed to supporting network infrastructure. However, it represents a philosophical alternative to custodial yield, earning BTC directly by contributing to its ecosystem. Node operators configure fee structures, manage liquidity between channels, and optimize routes to improve profitability. Although the average user may not generate substantial earnings, the decentralized nature of the process aligns closely with Bitcoin's ethos of trustless participation and financial sovereignty. Beyond Lightning, another passive income method has emerged through Bitcoin mining pools, which allow users to contribute hash power to a collective group in exchange for regular BTC payouts. While solo mining has become unfeasible due to high energy costs and hardware requirements, mining pools offer a way to passively earn small amounts of BTC by joining forces. Services like NiceHash even let users rent out their computing power to these pools, receiving Bitcoin in return, effectively earning yield without purchasing or maintaining ASIC hardware. However, this too comes with risks related to profitability, electricity pricing, and market volatility. Then there's the rise of Bitcoin ETFs and ETPs, which don't generate income directly but offer indirect access to yield-generating strategies. Some funds reinvest earnings or lend out their BTC to generate returns for shareholders. Institutional vehicles such as Grayscale's GBTC or Europe's Bitcoin ETPs may use lending strategies to improve performance, though fees and transparency vary. While this isn't true passive income in the DeFi sense, it represents a lower risk exposure for investors looking to gain from Bitcoin's yield potential within a regulated financial structure. As the institutionalization of crypto accelerates, more traditional financial firms are experimenting with Bitcoin collateralization strategies. Services now exist where BTC can be deposited as collateral for stablecoin loans, freeing up liquidity while the underlying asset remains intact. Platforms like Unchained Capital and Ledn allow Bitcoin holders to take out loans in USDC or fiat, using BTC as a guarantee. Although this doesn't earn yield directly, it enables the user to access capital without triggering a taxable event, and then potentially reinvest that capital into yield-bearing opportunities elsewhere. Used wisely, this method can replicate passive income without selling Bitcoin. Meanwhile, DeFi protocols built on non-Bitcoin blockchains continue to seek innovative ways to integrate BTC liquidity. Beyond wrapped Bitcoin, tokens like RENK, TBTC, and SBTC offer decentralized minting methods that aim to reduce custodial reliance. These alternatives attempt to preserve Bitcoin's decentralization while still enabling yield-bearing use cases across Ethereum, Avalanche, Arbitrum, and other ecosystems. As these technologies mature, we may see increased confidence and adoption, but current volumes remain small, and smart contract risk is a constant consideration. It's also worth discussing staking derivatives and synthetic BTC products, which can be combined in creative ways to generate income. Some protocols allow users to mint synthetic Bitcoin, like SBTC from Synthetics, and earn fees through market making or trading activities. Others enable users to collateralize BTC and issue algorithmic stablecoins, a risky but sometimes rewarding strategy. While complex, these approaches reflect the growing appetite for programmable Bitcoin exposure in DeFi, and they continue to push the boundaries of what passive income from BTC can look like. The expansion of Bitcoin's utility into the DeFi landscape also brings up the question of cross-chain bridges, which are essential for transferring BTC to other ecosystems. Platforms like ThorChain, Portal, and Chainflip aim to create seamless swaps between native Bitcoin and other crypto assets without needing to wrap tokens or trust centralized parties. As these technologies evolve, they may enable more decentralized forms of passive income, for example, by letting BTC holders earn yield through liquidity provision in native BTC pools across multiple chains. These solutions are still early, but they represent one of the most promising directions for Bitcoin-based DeFi. Another overlooked opportunity is affiliate or cashback rewards paid in Bitcoin. Several platforms, credit cards, and fintech apps offer BTC rewards for everyday purchases or referrals. Services like Lolly, Fold, and Bitrefill give users a percentage of their spending back in Bitcoin. While this isn't yield from investment in the traditional sense, it's a form of passive accumulation that grows over time, especially if BTC appreciates. For those who use Bitcoin as a savings tool, stacking sats through spending-based rewards can complement other yield strategies. Bitcoin's scarcity and dominance also make it attractive for use in hedge strategies and market-neutral positions that generate income. Some institutional investors use BTC as part of a delta-neutral strategy, for example, by going long on spot BTC and shorting BTC futures to earn funding rate differentials. These are advanced techniques requiring margin, execution precision, and ongoing management. However, they can produce relatively consistent yields in sideways or volatile markets, making them a unique passive income angle for sophisticated traders and funds. One of the more experimental frontiers of Bitcoin-based income is Bitcoin DeFi on Bitcoin native protocols, often referred to as Bitcoin Layer 2 DeFi. Projects like Sovereign on RSK and Alex on Stacks aim to offer decentralized lending, yield farming, and trading directly anchored to Bitcoin. Unlike WBTC, these platforms don't require bridging assets across chains. Instead, they build smart contract capabilities into systems that interact with Bitcoin natively or semi-natively. The promise is clear: passive income in BTC, earned on platforms built around Bitcoin's core principles. Yet adoption remains limited, user experience is often clunky, and liquidity lags behind Ethereum-based DeFi. As all these income strategies evolve, one key concern remains universal: security and self-custody. Earning yield on BTC often involves relinquishing full control, whether to smart contracts, custodians, or third-party platforms. Even protocols that claim to be decentralized may carry hidden admin keys, bugs, or dependencies that can jeopardize user funds. For many hardcore Bitcoiners, this contradicts the very ethos of Bitcoin, which was built on the idea of sovereign, self-custodied money. As such, deciding whether to pursue passive income with BTC is not just a financial choice but a philosophical one. The good news is that the ecosystem is progressing. Open source audits, protocol insurance, non-custodial interfaces, and Layer 2 education are all improving. Users now have more information, more tools, and more flexibility than ever before. Whether you choose to wrap your BTC, lend it out, stake it on sidechains, or simply earn through Lightning or cashback apps, there is no shortage of paths to passive income, and each offers different balances of risk, reward, and ideology. One of the most important steps before exploring any of these passive income strategies is to define your risk tolerance. Not all yield is created equal. Earning 8% APY on a platform that could disappear overnight is far riskier than earning 1% on a platform with proven security and transparency. It's crucial to ask, where does the yield come from? Is it sustainable? Who are the borrowers or counterparties involved? Are smart contracts audited? Are your funds rehypothecated or insured? These are the types of questions that separate smart investors from those chasing unsustainable hype. Education also plays a key role in maximizing income while minimizing risk. Whether you're engaging with Lightning nodes, smart contract staking, or cross-chain liquidity provision, understanding the mechanics of how your BTC is being used is critical. Platforms like Bitcoin Magazine, Swan Bitcoin, and Masari regularly publish educational material to help Bitcoiners explore yield responsibly. Even popular crypto YouTube channels and newsletters now dedicate content to Bitcoin passive income strategies, often breaking down complicated concepts into beginner-friendly formats. Moreover, tax implications should not be overlooked. In many jurisdictions, earning yield on Bitcoin, whether through lending, staking, or synthetic products, is considered income and is therefore taxable. Similarly, converting BTC into wrapped or synthetic assets may trigger a taxable event, depending on local laws. Consulting a crypto-savvy tax professional can help avoid unexpected liabilities and ensure you're optimizing both your income and compliance. This is especially important as governments worldwide increase scrutiny on crypto activity and reporting requirements. As adoption spreads and competition intensifies, the future of earning income with Bitcoin is likely to become more user-friendly, diversified, and decentralized. We're already seeing improvements in UI/UX across platforms, mobile apps integrating Bitcoin yield features, and wallets that offer plug-and-play stacking or lending. Innovations like Fedimint, which merges custody, privacy, and community-driven economics, are testing entirely new models for earning and saving Bitcoin in collective environments. The idea of earning BTC yield in a circular Bitcoin economy is gaining traction, especially in developing regions where banking access is limited. In parallel, the regulatory landscape will play a defining role in how accessible these income strategies become. On one hand, increased clarity from financial regulators may open the door for banks and investment firms to offer compliant Bitcoin income products. On the other, restrictive policies or unclear classifications could limit innovation, especially in DeFi and cross-chain environments. The balance between decentralization and regulation will ultimately shape the maturity and sustainability of BTC-based yield opportunities. Despite these uncertainties, one thing is becoming clear: Bitcoin is no longer just a passive store of value. Through staking derivatives, decentralized lending, Layer 2 integrations, wrapped assets, Lightning nodes, and even cashback rewards, holders now have numerous ways to make their BTC work for them. Each path carries trade-offs, and no strategy is completely passive, but for those willing to learn and explore, Bitcoin can be more than just digital gold. It can be an income-generating engine in the new digital economy. Subscribe to CryptoPulse for deep dives, tutorials, and objective insights into crypto's biggest trends.